This is an Uncovered Japan Company research report on Punch Industry, ticker 6165. Punch makes custom precision components that sit inside the molds and presses used to produce cars, electronics, and many other goods. The research case rests on a hard-to-commoditize niche, a recovery plan, and a below-book valuation. The central risk is that 59% of sales run through China. At the report's reference date, Punch traded at 12.6 times forward earnings and only 0.6 times book value, while offering a 3.96% dividend yield. Return on equity was 3.8%, which explains why the market applies a discount. The question is not whether assets are cheap in isolation. It is whether management can lift returns and operating margins through the next plan without a setback in China. The product is easiest to see as the component inside the tool rather than the consumer product itself. A mold repeatedly shapes plastic, while a press die forms metal. Punch machines the custom ejector pins, bushes, punches, and guide parts inside those tools, often to micron-level tolerances. Standard parts compete mainly on price and delivery. Punch focuses on bespoke parts, where a customer needs a specific geometry, material, and tolerance, then tends to reorder after the mold is qualified. By end market, automotive was about 42% of fiscal 2026 sales, electronics and semiconductors, 17%, appliances and precision instruments, 9%, and other applications, the remaining 31%. That is diversified by customer industry, but not by geography. Roughly 59% of sales flow through China. China's manufacturing scale is a major strength for Punch, yet it also makes Chinese demand, trade friction, and currency changes central to the earnings risk. Punch's financial history is cyclical. Revenue reached 42.1 billion yen in fiscal 2026, a record, and operating profit recovered to 2.03 billion yen. But the operating margin was 4.8%, still below the 7.7% peak reached in fiscal 2022. The slump combined slower China demand, weak factory utilization, and higher imported material costs. The recovery is real, but the margin gap is exactly what the next strategy must close. The net income chart shows why 1 year of earnings can be misleading. In fiscal 2024, operating profit fell to 1.24 billion yen, and restructuring charges pushed net income to a 0.58 billion yen loss. Fiscal 2026 operating profit and net income recovered to 2.03 billion and 0.85 billion yen. With a fixed manufacturing cost base, lower utilization squeezes margins quickly. Investors need to track operations and cash through the cycle, rather than extrapolate 1 year. Punch's moat is practical rather than absolute. It has 5 decades of know-how in custom precision parts, a production and sales network of more than 15 sites, and in-house design, machining, and quality assurance. Those capabilities let it follow customers across Asia and support repeat orders. The October 2024 alliance with Misumi adds logistics, mutual supply, and distribution reach. Misumi took a 10.9% stake, turning the largest standard parts competitor into a strategic partner. Management's Mirror VC28 plan aims for 45 billion yen of revenue in fiscal 2027 and 3.4 billion yen of operating profit by fiscal 2029. The longer Vision 60 ambition reaches for 80 billion yen of revenue by fiscal 2035. The plan combines stronger core mold components with a larger factory automation business and new businesses. The opportunity is a self-help recovery. The execution tests are domestic profitability, whether automation can scale, and whether the Misumi benefits materialize. The balance sheet is an important part of the strategy. The report cites a 67.3% equity ratio, about 6.4 billion yen of cash, and very little debt. VC28 allocates 4.5 billion yen to capex, 3 billion to M&A, and 1.7 billion to shareholder returns. That financial resilience helped Punch keep its dividend through the fiscal 2024 loss. But M&A is also a key dependency for building the factory automation pillar. On valuation, Punch is inexpensive, but the discount is earned by its current financial profile. The report places Punch at 12.6 times earnings and 3.8% return on equity, compared with roughly 15 times and 6.5% for the industry average, and much higher values for Misumi. The investment debate is whether the 0.6 times book multiple is permanent for a low-return cyclical or temporary, while VC28 lifts margins and return on equity. The scenario range is the report author's own estimate, not a price target or a recommendation. From a 505 yen reference price, the 3-year bear case is 355 yen. The base case, 915 yen, and the bull case, 1,665 yen. The base depends on VC28 delivering roughly 50 billion yen of revenue and a 6.8% operating margin by fiscal 2029. China demand, factory automation execution, and the Misumi synergies are the indicators to watch. Punch Industry is a niche leader in custom mold components, supported by repeat order relationships, a broad Asian network, and a strong balance sheet. The stock's below book valuation and defended dividend reflect low current returns, cyclical margins, and substantial China exposure. The recovery case has tangible proof points: operating margin progress, alliance benefits, automation growth, and the resilience of demand in China. For the complete source-linked 5-part research series, continue with the free Uncover Japan Deep Dive. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.